Welcome to Wealthy Ways, where we help you navigate the world of finance and investing. Today, we'll take a deep dive into the stock market and its storied history. The stock market, also known as the equity market, is a platform where publicly traded companies can raise capital by issuing shares of stock. These shares can be bought and sold by investors, and the prices of these shares fluctuate based on supply and demand. The origins of the stock market can be traced back to the late 1600s with the formation of the Amsterdam Stock Exchange. However, it was in the late 1700s and early 1800s that the modern stock market began to take shape. The New York Stock Exchange, the largest stock exchange in the world, was founded in 1792, and the London Stock Exchange was founded in 1801. Over the centuries, the stock market has played a crucial role in the growth and development of economies around the world. During times of prosperity, the stock market tends to see substantial gains, as investors are optimistic about the future and willing to take on more risk. Conversely, during times of economic downturn, the stock market tends to see steep declines as investors become more cautious and risk-averse. One of the most famous examples of the stock market's impact on the economy is the stock market crash of 1929, also known as the Great Crash. This event, which occurred on October 29, 1929, saw the Dow Jones Industrial Average lose nearly 25% of its value in a single day. The crash set off a chain reaction that led to the Great Depression, one of the most severe economic downturns in history. However, the stock market has also been a source of great wealth and success for many investors. Throughout history, there have been countless examples of individual investors and financial institutions making fortunes by correctly predicting market trends and making wise investment decisions. In recent years, the rise of technology has significantly impacted the stock market. The advent of online trading platforms has made it easier for individual investors to buy and sell stocks, and the growth of social media has made it easier for investors to access information and advice. In conclusion, the stock market is a complex and dynamic system that has played a critical role in the growth and development of economies around the world. It can be a source of great wealth and success, but also significant risk and loss. It is essential to always do your due diligence and research before making any investment decisions. Now, let's touch on two different types of stocks. Value and growth stocks are two different types of stocks characterized by their distinct investment characteristics. Value stocks are stocks of companies that are considered to be undervalued by the market. They typically have lower price-to-earnings ratios and higher dividends compared to the overall market. Value investors believe these stocks are undervalued and their prices will eventually rise, providing a good return on investment. They are looking for companies with strong fundamentals, such as a history of consistent profits and a strong balance sheet. On the other hand, growth stocks are companies that are expected to grow faster than the overall market. They typically have higher price-to-earnings ratios and don't pay dividends. Growth investors believe these companies have strong growth potential and that their stock prices will continue to rise, providing a good return on investment. They are looking for companies with a strong track record of revenue and earnings growth and the potential for future growth. It is important to note that there is no one-size-fits-all strategy when it comes to investing in stocks, and different investors may have different preferences. Additionally, it's worth noting that different industries and sectors have other characteristics and may lend themselves more to either value or growth investing. For example, companies in mature industries such as utilities or consumer goods may be more suitable for value investing. In contrast, technology or biotech companies may be more suitable for growth investing. Another important consideration when evaluating value versus growth stocks is the business cycle. During an economic expansion, growth stocks may perform better as investors are more willing to take on risk and pay higher valuations for companies with strong growth prospects. Conversely, value stocks may perform better during an economic downturn as investors are more risk-averse and looking for companies with strong fundamentals and a history of profitability. It's also worth mentioning that value and growth investing are not mutually exclusive, and many investors use a combination of both strategies. Some investors prefer to use a value-oriented approach for a portion of their portfolio, while also allocating a portion to growth stocks to create a well-diversified portfolio. In summary, value and growth stocks are two distinct types of stocks with different characteristics and appeal to different investors. It's important to understand each type of stock's various factors and risks and how they align with your investment goals. I can't leave out dividend investing. Dividend investing is a strategy that involves investing in companies that pay dividends, which are regular payments made to shareholders. Dividend-paying stocks can provide a regular income stream for investors and can help to generate wealth over time. When a company makes a profit, it has the option to either reinvest that money back into the business or pay a portion of it out to shareholders in the form of dividends. Companies that pay dividends are typically more established and financially stable, and they tend to have a history of consistent profits. One of the main advantages of dividend investing is that it can provide a steady stream of income, even during times when the stock market is not performing well. This can help to reduce the overall risk of an investment portfolio. Additionally, dividends can provide a source of income for investors who are retired or nearing retirement and are looking for a steady stream of cash flow. Another advantage of dividend investing is that it can help to reduce the volatility of a portfolio. Dividends tend to be less affected by market fluctuations than stock prices, which means that dividend-paying stocks can provide a more stable source of returns for investors. It's important to note that not all companies pay dividends, and the dividend yield can vary from company to company and from year to year. So it's important to do your research and find companies that have a consistent history of paying dividends and have a higher yield. Another important thing to consider when investing in dividend stocks is the sustainability of the dividend payouts. The company should have a consistent payout history and a payout ratio that is sustainable in the long term. A payout ratio that is too high could indicate that the company is not retaining enough earnings to reinvest in future growth and may not be able to sustain their dividend payouts in the long term. Additionally, it's also a good idea to diversify your dividend portfolio by investing in a variety of companies from different industries and sectors rather than putting all your eggs in one basket. This can help to reduce the overall risk of your portfolio and increase the chances of consistent dividends. Another thing to keep in mind is that dividend payments are generally considered taxable income, so it is important to take that into consideration when evaluating the returns of a dividend-paying stock. Dividend investing is a great strategy for generating a steady stream of income and reducing the overall risk of an investment portfolio. But it's important to do your research, be mindful of the sustainability of the dividends, diversify your portfolio, and consider the tax implications. Let's briefly touch on some of the metrics when choosing stocks and companies. When choosing specific stocks and companies, there are several metrics that investors can look at to evaluate the potential of a stock. Some of these metrics include price to earnings ratio. The P/E ratio is a valuation ratio that compares a company's stock price to its earnings per share. A lower P/E ratio indicates that the stock is undervalued relative to its earnings. Price to book ratio. The P/B ratio is a valuation ratio that compares a company's stock price to its book value. A lower P/B ratio indicates that the stock is undervalued relative to its book value. Dividend yield. The dividend yield is the annual dividend payment per share divided by the stock price. A higher dividend yield indicates that the stock is providing a higher return in the form of dividends. Earnings per share. EPS is a measure of a company's profitability, calculated by dividing its net income by the number of shares outstanding. A higher EPS indicates that the company is more profitable. Return on equity. ROE measures how well a company uses its shareholders' investment to generate profits. A higher ROE indicates that the company is more efficient at using its equity to generate profits. Peter Lynch, a well-known stock market expert, has given some advice on evaluating specific stocks and companies. He suggests looking for companies that have a strong brand, a good management team, and a product or service that is in high demand. He also suggests paying attention to a company's financial statements and looking for signs of consistent revenue and earnings growth. Additionally, Lynch recommends investing in companies you understand and have a personal connection with, as you'll be able to make more informed investment decisions. In conclusion, when choosing specific stocks and companies, it's essential to look at various metrics such as P/E ratio, P/B ratio, dividend yield, EPS, and ROE. Additionally, paying attention to a company's financial statements and understanding the company's product or service and management team can also help make informed investment decisions. And following the advice of experts like Peter Lynch can also be helpful in finding potential winning stocks. Let's get to the question I'm sure many of you want to know. Can you become wealthy by investing in the stock market? People can definitely become wealthy by investing in the stock market by utilizing a variety of strategies. One of the most common strategies is buying low and selling high, also known as capital appreciation. This means buying stocks at a lower price and then selling them at a higher price, potentially generating a profit. Let's recap on some of the strategies we touched on earlier in this video. Investing in high-growth companies, also known as growth investing. These companies are expected to grow at a faster rate than the overall market, and their stock prices tend to increase accordingly. Investors who buy these stocks early and hold them for an extended period of time can potentially see significant gains. Dividend investing, as previously discussed, is another strategy that can help people become wealthy by investing in the stock market. This strategy involves investing in companies that pay dividends, which are regular payments made to shareholders. Dividend-paying stocks can provide a steady income stream for investors and can help to generate wealth over time. Remember, value investing. It's another strategy that can help people become wealthy by investing in the stock market. This strategy involves investing in companies considered to be undervalued by the market. Value investors believe these stocks are undervalued and their prices will eventually rise, providing a good return on investment. Another way to increase the chances of success in the stock market is by creating a well-diversified portfolio. This means investing in various stocks across different industries and sectors rather than putting all your eggs in one basket. This can assist in reducing the overall risk of your portfolio. Many strategies can help people become wealthy by investing in the stock market, such as buying low and selling high, investing in high-growth companies, dividend investing, value investing, and creating a well-diversified portfolio. It's essential to understand the different strategies and risks associated with each and to find the one that aligns best with your investment goals, risk tolerance, and time horizon. That's a wrap for today's episode of Wealthy Ways. We hope you've enjoyed our deep dive into the world of stock market investing and the various strategies and metrics you can use to evaluate specific stocks and companies. Remember, investing in the stock market is not a guaranteed outcome and requires knowledge, research, and discipline. As always, we want to hear from you, our viewers. What other topics related to investing, wealth, and personal finance would you like to see us discuss in future videos? Please leave a comment below with your suggestions, and we'll make sure to cover them in future episodes. Remember to like, comment, and subscribe to our channel and hit the notification bell so you can watch all of our episodes. And as always, stay tuned for more insights and strategies on how to build and preserve your wealth. Thanks for watching, and we'll see you in the next episode of Wealthy Ways.